Every single historical chart pattern comparison that we've been able to capitalize on, and it's been a lot of them, right? That gives us a trading edge, rules of engagement with historical chart pattern comparisons. This is 1998, SPX, SPX. We had our death cross. I even tried to label them so it's crystal clear. Death cross 50 through the 200, death cross 50 through the 200 moving average. That was when I went all cash back in October, right? October actually is right here. We broke an uptrend line. And then things got ugly, okay? Things got ugly. Now, just dissecting this, we went into an uptrend here, right? And then we had a bull flag here and another bull flag here. This was this 40-day uptrend that just never ended and just kept paying us and paying us and paying us, right? And then we got a little shakeout here. And then guess what? We went to another uptrend, right? We got paid here. And then we had a shakeout. And then we went to another uptrend. I think this was a 22-day uptrend right in here. And now we're having another shakeout, okay? So these areas, these shakeouts that I'll put a circle around, this is not when you make your money. Now, if you're buying dips using 5-minute rules of engagement, trying to get swing long versus the 50 moving average or a pivotal low, understand you're swimming upstream, you're counter trend trading, and it's more difficult. It's more difficult to have conviction because you know you're going to probably go red before you go green. Okay, getting back to this. The S&P did hold this 50 SMA for a while. Now it ended up breaking it after a few times and broke it intraday and closed below it and then came right back. And we found support. So this 50 SMA, I think I would say 2850 is really big support. I understand the 50 is above that right now. 2850 is going, that's where I have this box because I think, well, 2860, 2850, this 100 handle trading range we could be into. We might break the bottom of it, intraday or even for a day and come back up. But I think for right now, the easiest money of the year is over because we're in a consolidation phase. That consolidation phase could last days, most likely weeks. Now, we already know, we've talked about this over and over again, where our lines in the sand are. I would say our first line in the sand is here, but this is really tight. So I would say the 200 SMA, 2775. And this one right here is probably pretty big. And I think this is on the daily update, 2722. Below 2722 is a very sloppy tape that could turn brutal, okay? Above this low, which is 2785, I still think is pretty bullish. If we get below the 50 SMA, I'm sort of neutral in here because I think it's just going to be sloppy. So we have our lines in the sand, our lines of defense. So if you're buying this dip, you got to give it some wiggle room. Bare minimum, if you're buying a dip, you have to use the previous day's low, or if you want to use a swing low. But understand, it's not easy. This is easy money right here. Buying it and getting paid right away because you are in an uptrend. Right? You have momentum on your side. If you are buying a dip, you do not have momentum on your side and you're sort of just buying blindly. And that's the reason why I say use the 5-minute rules of engagement. At least we have something in our corner.